Hello options traders, welcome back everyone. And I wanted to post a quick video to answer another email that I received from one of our traders here asking a really interesting question. And that is there a way to estimate the required stock price move that you need to offset the time decay in your option over a short period of time, let's say over the course of a week? So the answer is very easy if you're at expiration, but it's not so easy prior to expiration. So let's take a look at how you would do that. I think everybody knows that options decay over time, what we call time decay. And that's because you pay an extrinsic value for the option, that time premium, and all time premiums go to zero at expiration. There's no more time left. So it doesn't matter how much extrinsic value you paid, it all has to be zero come expiration. So that's what we call time decay. But what we're trying to figure out now is how much does the stock's price need to move over a short period of time, let's say over the course of a week, to offset that expected loss. How would you do that? Well, again, it depends on when you're trying to measure it. At expiration, the answer is very easy. It's what we call the options break-even price. So for a call option, you simply add the options price to the strike, and for a put option, you will subtract the options price from the strike. So for example, if you have a $50 call trading for $3, you just add 50 and 3, and that gives you a stock price of 53 at expiration. And if that stock has moved to 53 exactly at expiration, you will just break even. On the other hand, if you bought a $50 put for 3, you would subtract that $3 price from the 50 strike and get 47. And that just means we need that stock price to fall to $47 at expiration just to break even. But again, what his question was, what if it's prior to expiration? Now the answer is not so easy. And for that, we need to do a little bit of a trader's trick here. And we have to understand a couple more Greeks that are associated with your options. The first one is Theta. And Theta shows your options rate of decay. You'll see it right there on your broker's platform. And it's usually a daily number. Well, if that's true, we can estimate a weekly number by simply multiplying it by 7. It won't be a perfect estimate, but it's going to get you close. So for example, let's go back to our $50 call trading for 3. We look at our broker's platform, and it says that that call has a 0.05 theta. So we would expect, all things being equal, that this option is going to lose 5 cents tomorrow morning and be trading for $2.95. Therefore, over the course of a week, we multiply that by 7, we're going to lose about 35 cents on this option over the next week. The second Greek you need to understand is delta. And just as theta shows your option sensitivity to time, delta shows your option sensitivity for a given change in the stock's price. Delta will be shown on your broker's platform there, and it's going to be a number between 0 and 1. And what it does, it shows the percentage change in your options price for small price changes in the stock. Normally, we define that as a $1 move, even though that's technically too big. Again, it's going to get you close. So for example, let's go back to our $50 call trading for 3. We now look at our broker's platform, and we see that that option has a delta of 0.60. Keep in mind that delta is good only for right now. It's going to change as time changes, as volatility changes, and as the stock price changes. But right now, it is a delta of 60. So what that means is that if the stock rises, let's say $1 right now, your option will pick up 60% of that move, or 60 cents. So we would expect that call to be trading for about $3.60. What if the stock only rose 50 cents? Again, you would pick up 60% of that move, and your option would pick up about 30 cents and be trading for about $3.30. So delta just shows how sensitive your options price is for a given change in the stock's price. So to estimate the amount of stock price move that we need to offset our time decay, we just need to combine delta and theta. And you're just going to divide your 7-day theta by delta. So if we go back to our $50 call, let's say it has a 0.05 theta, and we said therefore the 7-day theta is about 35 cents, but we also know it has a delta of 0.6. So we're just going to take 35 cents divided by 0.6, and we get 58 cents. And what that means is that I need my stock to move 58 cents in the next week just to offset that time decay. What if I had a 30 delta? Same calculation, 35 cents divided by 0.30, and we'd need it to move twice that of 58 cents or $1.16. So you can see it depends on how much theta you have and what your deltas are. You're going to get different calculations. But the most important thing to remember is that these numbers that you get is necessary just to offset the options lost from time. It is not to make a profit. So do these calculations actually work? Well, let's go over to the CBOS calculator and take a look at an example. So here we are at the Chicago Board Options Exchange, or the CBOS option pricing model. And I'm going to look at an out-of-the-money option, but it doesn't matter. It works for any strike that you're looking at. So let's say the stock is trading for 100. I've got the 105 strike, 60 days to expiration, volatility 20%, and an interest rate of 3%. And when we click on calculate, the model says that the call option should be trading for almost $1.54. But now we look down here and we see theta is 0.026, almost 0.03. So we're going to lose almost 3 cents just from the passage of 1 day's time. So if I made this number over here 59 days, this number would decrease by almost 3 cents. So I can figure out roughly a 7-day theta by just multiplying this by 7. So if we do that, we get 0.1834. So roughly about 18 cents is what we're expected to lose over the next week. However, notice that my delta is only about 0.31. My option's not going to move dollar for dollar with the stock, so I just don't need the stock to move up 18 cents. It's going to have to move up a lot more than that. So let's take 0.1834 divided by 0.3087, and we're going to get a little over 59 cents. Let's say it's going to be somewhere around 59, maybe 60 cents that we need that stock price to move over the next week just to keep my options price the same. So let's take a look and see if it works. Remember, our options price here is about $1.54. So if we lose a week's worth of time, that's going to make this number 53, and we will see that the option is then trading for about $1.35, which is, again, about 18 cents lower than the price that we paid. But I also said I need the stock to move about 59 cents to offset that. So let's come up here and make this stock price 100.59, and let's see if that takes us back to our original options price. And there we are, back to $1.53. So again, it shows that the calculations work, assuming you're using a fairly small length of time. So you can certainly do it over the course of a week. But it's a very good tool to know because it's going to help you to understand if your stock is keeping pace with that time decay. Now, of course, there are a lot of strategies we can use to further offset this. Usually we do it with diagonals or vertical spreads. But for those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsaToZ.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.